Good morning. Hi, this is Professor Marsh, and it is the week of March 21st to March 25th. I have been grading your midterm exams, but this is the lecture for Unit 7, Chapter 7 in your book. So we're going to take a quick look at accounting information systems, and I'm also going to talk about some of the materials that I should highlight that is in your text. This unit has 7 learning objectives. The first is to define and describe and just try to understand the components of an accounting information system. And I will tell you right now that one of the most important things that I've put in your materials is a link. Or you could just go on YouTube and search for the tutorial videos for QuickBooks, and I've given you a link to the basic, very short, just a few minutes for each segment of the QuickBooks system. Just how to set up a new account, how to create a chart of accounts, how to enter transactions, and I think I also have how to reconcile cash, or some of those things. If you would spend some time now and just take a look at those tutorial lessons for QuickBooks that are in your coursework for Unit 7. You might have to hunt around a little bit to find the link, but it's a link to the site for the tutorial QuickBooks lessons, and then there's also links to Peachtree Sage, which is a more involved, more complicated, but more powerful accounting information system, which is used oftentimes by larger businesses. And then also a link to a third-party vendor who is a QuickBooks consultant that's almost, there's a video that's over an hour long that gets really how to do and how to use QuickBooks in depth. But if you would just take a look at those right now and get familiar with accounting information systems. Many businesses will use QuickBooks. Many smaller businesses will use QuickBooks. Many larger businesses will use systems similar to the Sage Peachtree system or that system itself. And some businesses just create their own spreadsheets and their own accounting systems using a worksheet program similar to Excel. And then some of them maybe even still use paper entries. But you can see in your book, when they discuss the history of ledgers and that sort of thing, how things have changed over time, and why companies, especially the big retailers like Walmart and Amazon, Macy's, that are all mentioned in your materials, can't rely on hand transactions, and especially now in the world of online shopping, they're absolutely essential. And so that's the first part, defining and describing the components of an accounting information system, and then describing and explaining the purpose of special journals, journals for cash receipts, cash disbursements, for sales and for purchases. Particularly when you have lots and lots and lots of repetitive transactions, and you don't want to have to set up an account for each particular customer or each particular vendor. You use these special journals and subsidiary ledgers in order to organize your cash receipts and disbursements, and also your relationship with your customers and your vendors. So that's the second objective, to describe and explain that purpose. Analyzing and journalizing transactions using special journals. I'm not going to spend a lot of time on that. I think that we probably need to go back to the first 5 units based on what I saw on your midterms, and look at journalizing and then entering T accounts for just basic transactions in the general ledger and in the general journal. In any event, I'm not going to spend a lot of time on that. There may be 1 or 2 quiz questions or homework assignments, but just read that material for understanding. And preparing a subsidiary ledger, I'm not going to ask you to do that either. And then I would like you to read about career paths, because certainly the career paths that are open to students who have both education in accounting and also in computer technology and information systems are quite exciting, and something that some or perhaps many of you may wish to pursue if you have a technical background as well as a background in accounting. So to define and describe the components of an accounting information system, accounting information system is defined as a set of business processes that record transactions using journals and ledgers, a paper-based system, or computer files, a computerized system, to keep track of a company's money or other assets. And so money, of course, is cash receipts and disbursements. The main assets that we look at for repetitive transactions are typically purchases of, particularly purchases of merchandise, inventory, and then also for sales. And you can have other, you can certainly have other information systems, accounting information systems. If you, if you're in a delivery business or a transportation business, you may have separate journals to take care of your fleet. Perhaps if you have a trucking company or delivery company, you might have a computerized system to take care of and track packages. If you're involved in any sort of merchandising nowadays that involves drop shipping directly to customers. So the key steps in an accounting information system are input, processing, and output. Input, this is the way that you record the transaction, and we went through that beginning in chapter 3. Processing is a method of combining similar kinds of information, like adding all the cash sales together to get a total that's separate from the credit sales, and then adding everything together to find the total sales. And then output is any way used to display the results of the processing. That's what output is. So output is how we display the results of the processing, and oftentimes the output is going to be designed to satisfy the needs of the particular business, and that would be different for example, General Motors versus Apple. They're just in very different businesses with respect to most of their business activities. They do both sell product, but certainly Apple has revenue streams that are far different than the ones that General Motors has, and General Motors has revenue streams that are different than what Apple has. So General Motors for a long time was very active in insurance and in financing, as well as car sales. Anyhow, that's input, processes, and output. Now, a source document is a record that the transaction has taken place, and it's often used at the input stage. So a source document, remember we talked about source documents with respect to chapter 3 and journalizing transactions, and we had some questions about that, but that's also very important for an accounting information system. And oftentimes the source documents provide backup that are used by auditors to make sure that the transactions are correctly entered. And then storage, this is any method used to save the results generated by the system. So data that's stored is retrieved and used in input, processing, or output stage. Additional data and information are also stored during these processes. Okay, 7.2, describe and explain the purpose of special journals and their importance to stakeholders. So we use special journals to keep track of large volume of similar types of transactions. And we use special journals to save time, because the same types of transactions occur over and over again. We don't want to have to reinvent the wheel every time we have another sale or every time another check is issued. So to decide which special journal to use, first ask, is cash involved? If the answer is yes, then you use either the cash receipts or cash disbursements journal. The cash receipts journal always debits cash, right? It's cash receipts. It's an increase in cash. An increase in cash is a debit. But the credit can be almost anything. Oftentimes it's just sales if it's a sale for cash. It could be accounts receivable if it's a payment on account. Or it could come from a third party like a new loan from a bank. Or perhaps it could come from an investment by a shareholder or other owner, depending on the type of entity. The cash disbursements journal always credits cash. Okay, crediting cash is a reduction in cash. It's like writing a check. Cash disbursements credits cash, but it can debit almost anything else. It could be a payment on account where we, bought on credit. So it could be it could debit accounts payable, reducing our accounts payable, or notes payable if we're paying on a note, or sales returns and allowances, or telephone expense, or many other things. Sales journal always debits accounts receivable and always credits sales. So the sales journal is easy. We use the sales journal for credit sales. And if the company uses a perpetual inventory method, and we'll get into inventories later on, but it also debits cost of goods sold and credits inventory. We're going to talk about inventory a lot more in the next unit, which is chapter 6 that we skipped over. Excuse me. The purchases journal always debits purchases. And if it's using the periodic inventory method, or inventory if it's using the perpetual inventory method, and it credits accounts payable. Okay, so when we purchase something and we don't pay cash, then what are we doing? Well, if we're using periodic inventory, which we'll learn about next time, we're going to debit purchases, and then at the end of the period we're going to make an adjustment based on a physical count of the inventory, or we'll just debit inventory itself. We'll add to inventory if we're using a perpetual inventory method, and we always credit accounts payable. We post the monthly balance from each of the special journals to the general ledger at the end of the month, and we post from all journals to the subsidiary ledgers daily. We use the general journal for transactions that do not fit anywhere else. So that can be for adjusting and closing entries, could be for sales returns or purchase returns. And the accounts receivable subsidiary ledger contains all of the details about the individual accounts. So, we have one big accounts receivable account, and then we have a subsidiary ledger under our main T account that's got all the detail about all the customers. So customer A, customer B, customer C, etc. And you've seen that in your materials if you read the chapter, and I strongly recommend that you read the chapter if you want to understand this stuff. The total of the accounts receivable subsidiary ledger must equal the total in the accounts receivable general ledger account. So when you add up all the subsidiary ledger accounts for all the different customers, that needs to equal the total that's in your general ledger account. And if it doesn't, then you're out of balance and you have to figure out what the difference is. The accounts payable subsidiary ledger contains all the details about the individual accounts payable. So all of our vendors, all of the people who sell to us on credit, that'll have, the subsidiary ledger will have all the details about all those different relationships, which can be very important because, what if somebody sends you a bill? I know that at one time I was, actually when I was a kid growing up, one of my neighbors was Bowie Kuhn, who was the commissioner of baseball at the time back in the 1970s. And Bowie Kuhn had been a lawyer in New York, actually, for the San Francisco Giants. In fact, he'd been their lawyer so long that he was their lawyer back when they were the New York Giants, back in the 1950s and early 60s, before they moved to California. And when Bowie Kuhn left the position of commissioner of baseball, he went to a law firm called Meyerson and Kuhn. Harvey Meyerson was a big rainmaker partner with one of the big New York law firms, not the one that Bowie Kuhn had been a partner in. But I guess he promised Mr. Kuhn a lot more money to be his partner, and so they formed a firm called Meyerson and Kuhn. And Harvey Meyerson brought in a tremendous amount of money in the first few years that they were in business together. And the way that Harvey did that is that at his former law firm, some of his other partners had billing relationships with some of the biggest financial companies in the world, and he knew who to send the bills to and how to mark the bills so that they would get paid. And so he sent out phony invoices to Sherman, Loeb Rhodes, and American Express, and some of these other, big companies in New York City, and they went to the accounts payable department, and since the invoices looked correct, the accounts payable department paid them, even though Meyerson and Kuhn had done no legal work for these particular large companies. And what the accounts payable subsidiary ledger did not have at these large companies, amazingly enough, was some sort of verification process that in fact this was an approved vendor. And so that led to a big financial scandal, the dissolution of Meyerson and Kuhn. And because it was a partnership, Mr. Kuhn was responsible jointly and severally with Harvey Meyerson for the debts of the entity. And of course Harvey Meyerson was unable to pay because he was sort of a scoundrel. And so Bowie Kuhn ended up being responsible for a lot of that. And he ended up moving to Florida. He sold his house in a hurry up in the Northeast and moved to Florida, where he bought a very large house, because Florida at that time, and still does, have an unlimited homestead exemption. It protects your homestead, where your principal residence, from the claims of all creditors, and he didn't want to lose his house to the claims of creditors of Meyerson and Kuhn. And the bankruptcy judge in the liquidation of Meyerson and Kuhn found that Mr. Kuhn had sort of fled in the middle of the night, and that this may have been a fraud on creditors, and so, or at least a preference, and so she demanded that the funds from the sale of the house in New Jersey be sent back to the bankruptcy estate to make available to the defrauded creditors. That was a very painful day for Mr. Kuhn and his family. But in any event, the accounts payable subsidiary ledger is supposed to contain all the details about the individual accounts payable, and it's supposed to add up to the total that is in the general ledger account as well, and it's only supposed to have approved vendors in it. So when you set up your business, make sure you don't pay anybody who hasn't been working for you. Okay, analyzing and journalizing transactions using the special accounts. So let's go back into the book itself for just a second and kind of go through the pages. Let's go through the chapter sort of on a page by page. I realize it's online, but let's go through this particular chapter and highlight some of the things that are most important in the chapter. And this is something that I think may be helpful. As I mentioned, when the chapter begins, this is back in section 7.1, you do see the example of the Macy's, day one cash journal, and they had $11.06 in sales the first day Macy's was open back in 1858, over 150 years ago. And the book points out that they do $24 billion in sales revenue now per year, which is far too much to write out in that pretty handwriting that looks like calligraphy that came from that particular journal. What I've heard is that back in the 1800s, that many professionals got their jobs because of their handwriting. Abraham Lincoln apparently had very pretty handwriting, and many people hired him as an attorney to write contracts because they could read his writing. Anyhow, I guess handwriting counted more back then than it does today. But you can see that accounting ledger, and then as the book points out, that in the 1970s there was as personal computers started to be used, there was a program called VisiCalc, which became available in 1978. And in 1981, when I started at Touche Ross, which is now part of Deloitte, a big CPA firm, they gave me an Apple II computer, and we had VisiCalc as a program that we could use on our Apple II computer, which had about as much power as the computer that went to the moon with the Apollo astronauts, which means it had perhaps 1/1000th or 1/1,000,000th as much computing power as you now have in your telephone. But in any event, VisiCalc was the forerunner of what almost everyone uses now today for spreadsheets, which is Excel. VisiCalc was probably an Apple program that was then stolen by the pirates of Silicon Valley, Microsoft, and turned into Microsoft Excel. But in any event, it was a good application, and it was the one of the first computerized spreadsheet systems. And I'm going to load into your materials for this unit. It probably won't be until this weekend, but I'm going to load in what I think might be some helpful worksheets that you can use for journalizing and perhaps for keeping T accounts. So in any event, please feel free to use them. Try not to goof them up too much. Don't oversave the original file so that you lose the model if you get in there and start changing formulas and fractions and links. But in any event, you'll see some of my worksheets in your materials, although you don't have to know them for the exams or anything or the homework. You may find them useful later on in the semester. So then, after we see the discussion of inputting and processing, and we see the source documents, and then output and storage, you can see all that, and there is a discussion of what are the source documents, what's input, processing, and output in a grocery store, doctor's office, that sort of thing. Just read and try to understand that information and understand it in practical terms. A good accounting information system is one that gives the business the information it needs to run its business efficiently and effectively, and which is also useful for producing the required financial reports, income statement, balance sheet, tax information that's needed by the business for financial reporting. And so that's it's one of those things where you try to make the system fit the needs of the business. And you can also see some information about the great convergence, the convergence of GAAP with the International Financial Reporting Standards toward the end of the material, but I wouldn't spend too much time on that. Looking at section 7.2, you can see examples of the various journals you have here. So you have a asset account receivable John Smith. So John Smith is a customer, and he bought $100 on credit from your store on June 1st. That's how you record something in the accounts receivable in the sales journal. The credits are always going to be to sales, and the debits in this case is going to be to accounts receivable. And I think almost all the times it would be to accounts receivable. It would have to be a barter transaction, I think, if it wasn't, if the debit side of the entry wasn't accounts receivable. Maybe if it was, if you remember To Kill a Mockingbird, at one point Atticus Finch had a legal client who couldn't pay him in cash during the Depression, and so he brought him, I think, a basket of chestnuts or something like that. And at that point, if Atticus was keeping his law firm's sales journal, he would credit his legal fee, and then he would put a debit. He'd put the chestnuts, chestnut inventory or chestnut supplies on the debit side, on the asset side of the balance sheet, to record that sale to that particular client. So, but usually it's going to be sales, credit, and following a debit to accounts receivable for credit sales. If it was a cash sale, it's going to show up in the cash receipts journal. And then you can see the subsidiary ledgers for they've got Elvis and Michael Jackson and Madonna companies on the accounts payable subsidiary ledger for supplies or whatever they've purchased at the company. And then you can see the accounts receivable subsidiary ledger, and this is looks like MJ and Roger Federer, Tiger Woods, Serena Williams, and this is of course these are for sales, so you can see the journal entries in those subsidiary accounts, subsidiary ledgers. And you can see the concept of special journals, and it's described in a figure 7.8 as to how they all go into the general journal. You can have, go into the general ledger. Entries that we have all been making into the general journal up till now could go through one of those special journals before they get posted into the general ledger. But at the end of the day, they need to equal, so need to balance out. And then you see the sales journal, sale to Jack Customer and Susan Carroll, and the debit to accounts receivable, and then you've got a credit to sales, and then you've got the debit to cost of goods sold and credit to merchandise inventory. We'll talk about this some more next unit. Okay, this is a type of system where you're keeping a perpetual inventory, and that's how that works. The types and purposes of special journals are displayed in a table, just in case you haven't gotten it so far. If you think in terms of these sorts of attribute lists, remember we had a list of attributes for different types of entities back in, I think, chapter 2, before we did the financial statements, and now we have a list of attributes of different types of special journals here in chapter 7. And that is, you can see how the subsidiary ledgers fit together into the general ledger balance with Smith, Jones, and Lee with their various balances. And you can see the T accounts that are kept for each of the three, and then the ending totals, and you add them together and they equal the balance in the general ledger, and everything's fine. And then there's a discussion of fraud with respect to subsidiary ledger fraud and dummy accounts. That's a often type of a financial fraud that's created where you set up dummy customers, dummy vendors, that sort of thing, much like Mr. Meyerson did. So anyhow, that's it for 7.2. Let's go on to 7.3, I do want to just take you through the sales journal and just talk about this a little bit. The sales journal and the accounts receivable subsidiary ledger, you can see how when payment is made that you can you're going to be offsetting these, but certainly in the sales journal you're going to see a lot of things about the typical entries to debit accounts receivable, credit sales, and then as payments are made, you're going to have a reversing or an offsetting entry in your cash journal when that payment comes in. So and then you see the various subsidiary ledgers for the accounts receivable, and you can kind of see how all the T accounts and the ledgers fit together, and that's a nice schematic representation that shows you where the numbers come from and where they go as they go from the journals and get posted into the appropriate subsidiary ledgers. In your cash receipts journal, you can see what happens when so this is the where the payment is made on account. This is where it says cash receipts journal, page 87 in figure 7.21, and that's right there. And then you can see the subsidiary ledger for Baker Company that's got the posting of the credit, the offset to the accounts receivable from Baker. They paid it off, and so after January 22nd they owe us nothing. So that's well done Baker Company. They paid what they owed us. Okay, you can see this. There's no magic to this, and again, I want to go back to the journalizing and ledgers that we really need to master in units, particularly in Unit 3, Chapter 3, but really all of the materials from Chapters 2 through 5. We need to go back through those, after the midterm. I think what I'm going to do is to assign you a comprehensive example of what it is we're doing in this material, and then ask you to go through and just copy what I've done, is to watch me do it, and then you do it yourself and develop the muscle memory of doing it yourself, because several of you I don't think know how to get started, and I want to make sure that you can do this before we get into some of this stuff here with these subsidiary ledgers and this sort of thing is not really anything at this point that we need to focus on in much more detail. Just understand that there are special journals, that there are subsidiary ledgers for these repetitive transactions, and that it's an important part of accounting. Do the homework for this chapter. I'm not telling you not to do the homework. Definitely do the homework and do the quiz. You have to learn this material well enough to do the homework and the quiz. And if you're having trouble with the homework, go back into the section of the book that the homework relates to. Every one of these homework questions tells you what section it comes from. Look for the example that looks most like the answer to the question, and see if you can follow it and figure it out from the example that's in the book. Now, when you get to the end of all that, if you want to think about careers in this part of accounting, there is section 7.5 that does have a very good discussion of some of the careers that are open to people who master this type of accounting. And this type of accounting is where you really get into the beginning of forensic accounting, where you're looking for financial fraud or malfeasance, or just trying to solve an important problem, or perhaps come up with some improvement in the systems for your companies. But the book discusses cryptocurrency. It discusses blockchain. These are challenges for people who were trying to do that sort of auditing or forensic accounting, because sometimes it's difficult to get source information about cryptocurrency. Sometimes it's difficult to find out who is the actual owners of various entities, and who are the real parties to a transaction, in situations in which you have a very complicated structure of ownership. Then there's a discussion of enterprise resource planning, and that's a collection of integrated programs that track all operations in the company. That is big with a lot of the big retailers, and there's also a discussion of artificial intelligence and using some of the breakthroughs in AI to assist in in terms of data entry, in terms of storage and processing and output, and of course in terms of controls and diagnosing problems or misconduct. So computerized AI systems have brought big changes to the way that audits are performed in many companies and in many practices in accounting. And then there is a discussion about the Securities and Exchange Commission that now is almost 100 years old, and also the Patriot Act, which again deals with blockchain and the need to verify who in fact we're doing business with. We don't want to do business with a company that's owned by a trust and find out that the trust is owned by a foreign bank and find out that the foreign bank is owned by a terrorist. And that's something that the Patriot Act was enacted in order to protect against. So this is chapter 7. It's an important chapter, but I want you to do all the material here, do your homework, do the quiz, but then also make sure and go back and review your midterm exam. I'm going to post another video about that in just a day or two, so you can go back and look at particularly look at the problems. Many of you did quite well on the multiple choice, but really had a problem doing those problems. And so I'm going to have a comprehensive example for you to follow, that if you master that, then you will have mastered the material for the first 5 important chapters of the book. And so get ready for that and make sure that you watch that. So with that, have a great day, and we'll talk with you again soon. Thanks a lot. Bye-bye.